During 2021, you'd be forgiven for thinking that the GameStop saga was the first time in history that markets had gone a little bit haywire. But for students of history, that's simply not the case. Markets have been misbehaving since they were born. Market participants are always on the lookout for a way to make a quick buck. And today, we're going to travel back to 1955, the year when two onion traders, Sam Seigel and Vincent Kosuga, cornered the onion futures market on the Chicago Mercantile Exchange. The resulting regulatory actions led to the passing of the Onion Futures Act, and that's why you can't trade onion futures today. In 1955, onions made up 20% of the commodities traded on the CME, and Sam and Vincent saw an opportunity. The pair began buying onions and onion futures, millions upon millions of them, which made them millions upon millions of dollars. Our story starts with Vincent. Prior to his stint on the commodity markets as the king of onions, he was a relatively unimposing 5-foot tall onion farmer who had turned an unwanted 5,000-acre patch of dirt into an onion-filled Garden of Eden. However, just making money growing onions apparently wasn't enough for Vincent. Before turning his attention to onions, Vincent actually had a career trading wheat. But he wasn't so successful in this venture, and he messed it up so badly, he brought the family to the brink of bankruptcy. The family had to borrow money from a friend just to stay afloat, and his family made him promise never to try it again. But alas, ignoring the pleas of his family, Vincent soon went back to trading. Only this time, instead of trading wheat, he stuck to what he knew and began trading onions. So before we go any further, let's have a crash course in the economics of onion trading. Onions are a fairly lucrative market, and this has a lot to do with the limited storability of onions. Onions are planted and harvested at a very specific time during the year, which means for traders, the price of onions has the potential to fluctuate wildly on a day-to-day basis. For example, when the onions are harvested, they typically command a high price due to the fact that the market has been virtually devoid of them for many months, and the remaining stores of the previous crop are probably going off by this time. This inevitably led farmers to flooding the market with their harvest at the same time in a desperate effort to get the best price, which in turn dramatically ended up lowering it. This is really just a lesson in basic supply and demand economics. When the supply is high, the price is low. So if you can identify this pattern and somehow control the supply, you can probably influence prices. As an onion farmer himself, Vince had a considerable advantage over other traders, and he quickly became a rich man buying and selling onion futures. Okay, now you understand the economics, let's understand the finance. If you've seen the movie Trading Places, or if you're knowledgeable about commodities trading, you probably know what a futures contract is. If you don't, a futures contract is simply a contract to buy a certain commodity at a date in the future for a price set today. The buyer of the contract hopes the commodity price will go up in the interim, while the contract seller hopes it's going to go down. Shorting the futures market, or short selling, happens when a seller of commodities futures contract does not yet own what he or she is selling. The seller borrows the commodity future from an owner, sells them, and buys them back at a later date, hoping the price is lower. The short seller hopes that the price of the commodity will obviously go down between when he or she borrows it and when he or she repurchases it, thereby making a pretty penny on the difference. Okay, that's all getting a little bit complicated, so let's just go back to the basics. What Vincent was doing was buying onion futures in the hope that the price would go up when the date of delivery arrived. He could sell the contracts for a profit. The thing is, as an onion farmer, Vincent held considerable sway over the market anyway, and also wasn't adverse to shady dealings to turn a profit. So Vincent understood there was a variety of options available to him to make a profit from onion farming. He could make money if the price went up or down, or if there was some sort of event that could influence the supply of onions. One year, Vincent desperately needed the price to go up in order to make a profit, and he knew that his own crop was coming along very nicely, Vincent knew that the rest of the market would also have a very nice crop, and hence when the time came to sell, the market would probably be full of onions and the price would drop. So in an incredibly sneaky move, Vincent bribed an official at the Chicago weather office to issue a severe frost warning, which in the market's view would lead to many onion crops failing. This would of course reduce the supply of onions and therefore drive up the price. There was of course no such frost coming, but when the news leaked, people began panic buying onions, driving up the price, and of course Vincent had the contracts in place to ensure he profited nicely from this mayhem. And so this brings us to 1955, when Vincent teamed up with Sam Seigel for his biggest move ever. You see, Seigel owned a cold storage facility where he used to store, among other things, onions, and between the two men, they effectively had the physical and financial capability to buy and store almost every onion in Chicago. So that's exactly what they did. And in the autumn of 1955, after almost a year of frantic buying, Sam and Vincent own 98% of the onions in Chicago, about 30 million pounds. With literally the entire supply of onions under their control, the men were able to artificially inflate the price of onions to around $2.75 a sack. But they weren't done. After inflating the price of onions, the men enacted the second phase of their plan, where they began short selling onion futures, which meant they were essentially hoping the price would fall, and they would later buy them back for a fraction of the cost, making a potentially huge profit. Now, since they own pretty much every onion in the city, they could of course guarantee that the price of onions would fall simply by flooding the market with millions of onions they were holding in reserve as soon as the sales were final. By March of 1956, the price of onions fell so much that they effectively became worthless. From the $2.75, they were down to around 10 cents in just the span of 6 months. The onions, in fact, were worth less than the sacks that they were being sold in. Dozens of onion farmers experienced a new way that onions can make your eyes water, and many of them went bankrupt. Millions of rotting and worthless onions ended up being dumped across the city. Onion producers were obviously losers in this situation, and they were going out of business. So they turned to Congress and a particular guy called Gerald Ford. He was a congressman from Michigan, and he sponsored a bill outlawing the trade of onion futures, a very specific bill aimed at preventing this very specific type of endeavor. The commodities trading lobby, of course, opposed the bill, threatening litigation if it was signed into law. President Eisenhower called their bluff and signed the Onion Futures Act in the summer of 1985. The CMA sued and lost, so the trading of onion futures is banned in the United States to this day. As for Vincent and Sam, they got away completely scot-free because they technically had not committed a crime as the result of Vincent's action. In fact, Vincent was famously quoted saying, "If it's against the law to make money, then I'm guilty." After the futures market was reformed, Vincent returned to New York full-time to focus on his local business interests and philanthropy. Vincent actually ended up opening a restaurant next to his farm called the Jolly Onion, which has gone on to become one of the most popular restaurants in Orange County. And it's still open today. And that's the story of Vincent and Sam. As long as we have markets, there'll be market failure. To learn more about crazy market shenanigans, check out this video about the emu bubble.